So what do we have here? We have energy prices rising again. This month they're rising, right? We're going to see a huge jump in CPI. We have food prices rising again. We're seeing it. We're seeing it across the board with food companies that are reporting they're raising prices. You're looking at rental properties and rents not going down anytime soon, which we know, right? That's 55% of the CPI. So we're going to see the October CPI get reported in 2-3 weeks. It's likely going to rise month over month, which is insane. And we're going to show that the core CPI, which is what they look at, right? Excludes food and energy, has still not peaked. It's not like it's peaked and we're seeing it come down slower and slower and slower. It hasn't peaked yet. So how can the Fed slow these rate hikes or say, hey, we're going to stop raising rates, especially as this is going on? And now with the market starting to get a little bit of a bid here and people say, well, it's going to continue for the fourth quarter. If it is, we're probably going to see even more of a collapse when it comes to first quarter. I think it's going to happen even in December. I mean, or after this earnings season, we might see a little bit of a pop when, stocks usually do well when you have a split government, and it looks like the Republicans are going to take back not just the House, which is expected, but also the Senate right now based on the polls, which, we saw what the polls were last time, so who could believe them, right? I think they had Trump losing, Ohio by 12 or 15 points, and he won. I mean, some of these polls were insane, but right now that's the expectations. Even the biased polls and Democratic polls have the Republicans really starting to surge right now. So that could be a little bit of a catalyst, and that's election in, early first week of November. But other than that, when earnings are over, again, these estimates keep getting revised lower and lower and lower, and that's what you're going to see. And yes, it's easy to beat them, and you can say, wow, things are good, but you're looking at the 10 years still over 4%. You're looking at the 2-year at 4.4%. You're looking at mortgage rates over 7%. The dollar has retreated a little bit, which is why you're seeing a little bit of a rally, but how could that continue? I mean, I talked about plenty of disinflation areas of the market, and I said, well, the Fed would have to, I never thought the Fed would be going over 4%. They're going to be over 5% next year, and for most of the year. I mean, forget 4%, it's going to be 5% now. And that's why I changed my tune. I'm like, wow, the Fed is really looking at the two gauges that they only care about unemployment, and that's staying artificially low, and you have the CPI, which is going to, it's not going to moderate anytime soon. I mean, you really think we're going to get down to 2%? Even if they change it, which they're going to change, right? They always change, and revise and say, well, it's probably going to be more like 3.5%. We're not going to 3.5% next year unless you raise rates considerably. And that's what they're going to continue to do because that's the gauge that they look at. But disinflation, you look at housing, right? Not rentals have come down. Commodities are like copper and lumber. Lumber prices are up 25% this month. Copper prices are up in October. Soybean, canola, a lot of these big price inputs into food now rising again. Sure, you have PCs, technology prices coming down as we have supply gluts, same with cars, but Apple stopped production on iPhone 14s because it's seeing slow in demand, and even that's catching a bid here, which is surprising. But the gauge the Fed looks at is the CPI, and it's still going higher. So the price is going higher, and the market's rallying here. I'm going to ask the question, how can the Fed stop raising rates? What makes you think they're going to stop raising rates? How can they? They're going to stop raising rates with the CPI at 7-8% and staying there? I mean, the market's rebound and gives them a little help because people, the market, you say, well, it's supposed to be different from the Fed, but it's sentiment, right? When the markets go high, people are going to be happy. They have more money, they're happy, they're going to spend more, right? They saw that house price come down considerably in most areas, and it's still coming down. It's going to come down sharply more. And the markets have come back a little bit, but even with the markets coming back, you're going to see sentiment, maybe gain a little bit, get a little bit stronger, but it's given the green light for the Fed to continue this policy. And that's what's scary because they already overshot. They clearly overshot. They just don't have the patience to wait this out. I mean, they thought inflation was transitory, that everything they've learned for 40 years. It was transitory for 20 years, right? All of a sudden, in the blink of an eye, they switch. It's never going to be transitory. We got to keep raising and raising and raising, right? It's just a big flip-flop. That's why I said that most of these guys should be fired. They're not qualified to run in this type of market or run the Fed in this type of market. If you thought it was transitory at 5%, it went to 9%, and now all of a sudden it's not going to be transitory at all. It's after you raise rates considerably from basically 0 to 4.5% by the end of this year, at least, you got to figure that you're going to see a much, much quicker slowdown, but they're not anticipating that. They're like, no, forget it. So It is interesting. It's a tough market. 3 months ago, a 4% Fed fund rate forecast for all of 2023 was absolutely insane. Will likely be over 5% for much of next year. And I can't see how that's not going to result in a collapse in asset prices across the board, especially equities. I mean, you have no Fed help. They're not going to be buying bonds, injecting money directly into the economy, which we call QE. Mortgage rates well over 7%. Okay, you've seen that collapse in the housing market outside of a few states, which is a massive, massive driver of the economy. Look at Europe, look at China, look at Japan, and then look at most emerging markets are getting wrecked, which means as rates go higher, they're going to get wrecked even further because they're filled with debt. And what are they going to do? They're going to buy the dollar. It's going to push the dollar higher, which remains near 12-year high against most currencies. It has come down, which is leading to this rally. But how do we see the dollar continue to come down when we're raising rates and the global economy is getting wrecked? They're going to be buying the dollar. So the 2 years, over 4%, 10-year, over 4%, 2 years over 4.4%. I mean, so even the 2 year over 4.4%, that's risk-free. That's risk-free. That's a risk-free rate. And if you compare that to the S&P 500, which pays a 1.8% yield, which one would you rather buy right now? Because you got one that's risk-free, guaranteed, and on point, 4.4%, or, hey, you know what, the S&P, yeah, it's got a nice yield, but now you're taking on the risk of buying a super expensive index. It's extremely expensive based on how much earnings are growing. So when they say the multiple is around 17 times on average for the past 5 years, and over the past 10 years it's 15 times, that's based on zero interest rates, and that's based on more than 10% growth in earnings annually, year over year over year over year, which we saw a lot of those years. Now we have interest rates skyrocketing, which should bring that multiple down. And now you're looking at the growth in earnings at 3% year over year. We should be trading at a 10 multiple, 12 multiple tops. That's 16, 17 times. That's crazy. Do you want to buy the S&P 500 at those levels? An index not going to grow year over year, 2023 most likely at this level, paying a 1.8% yield, or let's just buy the 2 year. I don't know. I say buy the 2 year. Yes, you have to have exposure. Maybe the Fed just totally stops and says, okay, we're going to lower. Who knows? I mean, you have to have some long exposure, but you could see that when you're looking at 3, 6, 9 months, I mean, it's not pretty. It's not a pretty picture. The only way stocks continue moving higher for it is the Fed not just pauses on rate hikes, but anticipates or signals that's going to start lowering. That's not till mid-2024, maybe. But we have inflation that's still surging. So I'm not sure how the Fed can slow the pace of rates anytime soon. It doesn't make sense. Which again is going to hurt the global economy, which many countries are already in a recession. Results in a higher dollar, which is terrible for our equities market, especially gold. No more bond buying, QE from the Fed, but the opposite where they're removing money from the market. So that's a terrible market for risk assets. But enjoy the bear market rally. Companies doing everything they can to meet their revised, lowered estimates. Maybe they start buying back their stock soon, since they slowed considerably. They're drastically cutting costs, which doesn't mean, you would think like the economy is great if you're watching TV, but they're drastically cutting costs. They're closing factories, spending less on CapEx, cutting back marketing, laying off tons of employees across technology. I don't think you'll find a major technology company that hasn't laid off employees, while also considerably raising prices, which is unsustainable if you think about it. I mean, you're raising prices while not providing the same services, with fewer people helping you. You want proof? Try calling a customer service department today. You're going to be on for 45 minutes. Airlines, banks, retailers. Hey, what happened to India and stuff like that? Even they're too busy to answer your call. Restaurants are charging more than ever with prices going up. Their profit margins are surging, so they're not just like, oh, we have to charge higher prices because our import costs are higher. No, they're charging higher prices on top of the higher import prices, right? Input prices. And yet they have fewer employees and fewer items on the menu. You're seeing that across the board with so many restaurants, even fast food places. So how do you provide the same level of service? You can't, which is going to result in fewer customers. And then you have the Fed taking money out of the system when most people don't have the buying power they had a year ago when rates were super low. The home value was surging. They felt more confident, even with the markets at all-time highs. But now with rates surging and most people having debt across every country, including most consumers in America, their payments are much, much, much higher. Not just from rising rates, but also inflation. So something has to break. And we're seeing the cracks, right? Central banks flip-flopping in weeks between QE, quantitative easing, QT, quantitative tightening. In weeks, they're flip-flopping. Oh, shit. No, we can't. Oh, my God. Wait. We're raising rates. Oh, wait. We're going to buy bonds. Wait a minute. These are central banks. I mean, it's like Exxon buying a $10 billion facility in Saudi Arabia and then selling it a week later going, holy shit, we were wrong. You don't see stuff like that ever. But be very careful here.